On July 2026, the Indian stock market witnessed a massive wealth creation event. In a single afternoon, 13 corporate employees became instant crorepatis. The top-tier holdings were significant. Deputy Managing Director Devinder Pal Singh held shares worth 121 crore rupees, while Chief Investment Officer Srinivasan Rama Iyer saw his holdings reach 105 crore. SBI Funds Management, the entity behind these gains, is India's heavyweight in asset management. With backing from the State Bank of India and global giant Amundi, the company carried immense institutional expectations into its public debut. This chart tracks the actual market entry. The stock opened at 574 rupees and moved to 613 rupees and 30 paise, a modest 6.85% premium that stood in sharp contrast to the massive wealth generated for insiders. We have to ask how a financial powerhouse capable of minting over a dozen multimillionaires could deliver such an underwhelming first day for the general public. Finding the answer requires looking past the listing day noise to examine how the company actually generates its revenue. Millions of retail investors funnel automated fractions of income into a central pool through systematic investment plans. SBI acts as a toll booth on this assets under management, collecting a fixed percentage fee. This consistent influx protects the company's steady profits from daily market volatility. This reliable fee-generating engine is the reason the company is a multi-billion-dollar behemoth, but it also helps explain the lack of a speculative spike on the stock exchange. To understand the quiet IPO, we have to look at the mechanics of the share sale itself. This IPO was an offer for sale, or OFS. As the diagram shows, a portion of equity simply moved from existing owners to the public. The company's total capitalization remained the same, and the business itself raised zero new capital for growth. Public investors were simply providing an exit for early shareholders. None of the money raised from the IPO was used to build new technology or expand the business. Without that fresh capital to accelerate future earnings, the stock lacked the speculative pressure to drive a massive price jump on its first day. The final factor in the 7% listing was the cold math of market valuation. The price-to-earnings ratio is an investor's weighing scale, representing rupees paid today for 1 rupee of profit. Pre-IPO, the market paid a multiple of 38. Post-listing, it adjusted to 40.72, 40 coins balancing perfectly against a single rupee, keeping the scale completely stable and horizontal. A PE of 40.72 placed the company just slightly below the sector average. The market priced the stock with high precision, avoiding both a bargain entry and a speculative bubble. The 6.85% premium reflects an efficient market that calculates value based on fundamentals rather than momentum. If the public market was so calculated, how did 13 employees manage to secure 100 crore rupees each? The answer is the Employee Stock Ownership Plan, or ESOP. This system grants equity to staff as a part of their long-term compensation. This wealth accumulated over years of quiet compounding. As shown in this blueprint, these employees held their equity since the company's foundation, benefiting as the managed assets grew from a small pool into a massive multi-billion-dollar skyscraper. Institutional analysts expect this growth to continue. Based on the expansion of India's retail investment habits, brokerage firms have set target prices between 675 and 750 rupees. Future performance will depend on how the company handles the rise of low-cost passive funds, changing government regulations, and the eventual end of lock-in periods for insider shares. The SBI Funds Management listing highlights a transition toward higher valuation precision in Indian equities. Generational wealth in this sector is found in the calculated, long-term compounding of assets, rather than the volatility of a single day's trading.